In this example, we have A Limited that acquired an office building for 1,090,000. Cost of construction at 1 July 20.12. The expected dismantling and removal costs at the end of the useful life of the asset. Now this is at the end of the useful life of our office building is 120,000. Therefore, you need to identify that this is a future value. The applicable discount rate after tax is 6.48%, and the useful life of the building is 24 years. Now, our first question, is there a legal or constructive obligation? And they include that we can assume as per the agreement that there is. Then our first step will be to estimate the costs of our dismantling. They provide us with a 120,000 future value. The useful life is 24 years, and we need to take that discount rate and add back the tax. Now guys, please ensure that you have added this to your revision page. You need to use a discount rate before tax, okay? And our present value will be 15,169 that we may capitalize to our asset. And this will be our step 2. We will capitalize that amount against our asset. Therefore, our journal entry will be to debit our office building with 15,169 and credit our provision account. Then at the end of year 1, we will have to credit our provision account and debit our finance costs with a 9%, and we will use our balance of our provision, the 15,169 times 9%. Year 2, we need to recognize the growth, therefore credit our provision and debit our finance cost with the initial amount in our journal 1, and we will have to add our second journal's amount, 1365 times 9%. And guys, then it goes on until the end, and in year 24 you will have to credit your bank when payment is made. In this example, we will look at changes in dismantling costs. You will identify, to save us recording time, that I have already included calculations and a timeline on the right hand side of your screen. Now let's start reading through the information. H Limited erected an asset during 20.12 and completed it on 31 December 20.12. The asset must be dismantled after 20 years. On 31 December 20.12, the company estimated the dismantling costs at an amount of 150,000, assume a fair discount rate of 5% before tax, and the year end of our entity is 31 December. Now stop. Please do not look at the solution. I want you to think about this. You need to determine, is there a legal or constructive obligation? In this question, you can assume yes. Next step, you need to calculate the present value of the estimated costs to dismantle the asset at the end of the useful life. And they've provided the future value to us. Second step, you will have to capitalize step number 1's amount. Now, when you look at our timeline, our initial recognition date is 31 December 20.12. They've provided us with an estimate future value of 150,000, period 20 years, and our discount rate before tax 5%. 5%. Our present value on initial recognition will be 56533. Remember now your journal entries, guys. Your journal entry will be to debit the asset with a 56533, credit the provision. Now, at the end of 20.13, we need to recognize the interest based on 5%. Therefore, this will be the 56533 times our 5% and interest amount of 2827. We will have to debit our finance cost and credit our provision. Now, at the end of 20.14, we have initial amount of 56533 plus our journal entry of 20.13 times 5%, and this will be an amount of 2869. We will have to debit our finance cost and credit our provision. Now they indicate to us on 1 January 20.12, the dismantling costs were reassessed, and this will now be 250,000 at the end of the useful life. Therefore, guys, are you with me? If we now identify that the remaining useful life will now be 18 years, and we need to determine what is the present value of our 250,000 if we discount this using 18 years and our 5%. This will be 103,880. Therefore, this will now be our new provision amount. This will be the provision amount that has to be included in our statement of financial position on 1 January 20.15. Now it is important that you understand, guys, what is the amount that is currently in the records of H Limited? This will be our first journal entry, the 56533. Then we need to add our interest portion of 20.13, therefore plus the 2827. And we need to add our interest portion for 20.14, therefore plus the amount of 2968. And our old value will be 62328. And this will result in an increase of 41552. Remember, if there's a change in an estimate, you need to immediately identify IAS 8 disclosure, and you will have to test for impairment in terms of IAS 36. Now, IFRIC 1 indicates to us, due to the fact that we use our cost model, we may now debit the asset with a 41,552 and credit our provision for dismantling costs.